It's been a while since we've had a good old bear drop. All right, so yeah, price action peaked at 56.42 at market open, and we just tanked throughout the day. SPX losing 88 basis points, but Nasdaq falling 220. On the ES side of things, we tapped a few dollars below where I had that estimated high in the pre-market, and then dropped all the way from there. A lot of this due to a little bump in commodities, but not so much as the drop in leverage from the dollar and a big breakdown in dispersion through the intraday. Now they did try to reverse this into the end of the day, and they might be better positioned for a move up tomorrow still. So the continuation of today's price action is definitely not guaranteed at this point, and they are going to try to reposition and regain ground if they can off of the PPI print, which might be hot. We'll see. There's a lot less data on PPI, and I don't track it as closely as I do CPI, but input costs are definitely climbing. I put that in the like kind of macro summary at the beginning of the week in the Pickles picks, and they're climbing at a rate greater than service prices are falling, right? And so consumer right now is benefiting from the prices of services pulling back a little bit, but those input costs are inching up, and right now, today's CPI print shows us that they're not being passed forward at the same rate of efficiency that they were in the past. And if PPI cements that tomorrow, that's very bad for margins, right? Over time, that means corporations are deciding to carry more of those losses in order to improve their sales, which have been declining at a very rapid rate over the last quarter. So if you look at GDP, total like sales and business corporate profits, they're down really hard, and corporations are going to try to reverse that, right, in order to maintain their market share. And but in the process of doing that, it will also mean that they'll have to eat the poop sandwich that is current inflation and input costs, instead of the consumer, and that is distinctly not bullish, right? You have companies trading at 30, 50, 60, 80 x their forward earnings, and a lot of those earnings are due to like 12-20% margin increases on the back of what is realized like 20-30% inflation, right? And if corporations are losing market share, they're gonna pull back on that overcharging of the consumer, right? They're gonna eat some of those losses, and their margins are gonna contract, but their sales will go up, and that's how they maintain market share. And that process can play out for a very long time, but it's generally not bullish for equities, right? Especially consumer-facing equities. Business to business doesn't get hit as hard, right? But anything that's propped up by consumers, it's quite rough. And obviously more and more data that hints at that, the more bearish that can become. But today was the first taste of that, and the market reaction was extreme. I would say it was a pretty big reaction. This also came with a big breakdown in the carry trade. Obviously, multinationals really benefiting from that higher dollar, not so much when the dollar falls, and the spread between USD and JPY collapses, right? And it didn't collapse much actually relative to the market movement, or as much as it should have, given what today's data could indicate for rate cuts. But if rate cuts do start happening, this leverage that has been largely pushed into short volatility positioning is going to collapse, right? And it will no longer be safe or profitable to continue to short volatility in the way that we have seen it shorted, right? The correlation between the forward convexity of volatility and the JPY leverage ratios have been like 1-to-1 for the last year and a half. And so, a lot of this leverage is going directly into short vol. And so as the spread collapses here, the leverage diminishes, right? And so does the ability to short volatility willy nilly. Bumped up today. We had almost almost 200 basis point drops across the board, especially in the mid range of the curve between the 2 and 5 year, and a little bit on the 10 year, but bounced back into the end of the day a little bit. Which we can see right here. Yeah, so yields bounced back from their low a little bit after the 30-year auction, printed quite a tail, and that honestly is probably the only thing that stabilized the market, ironically. Skew pulled back again yesterday, although I feel like we're going to probably see this turn around pretty sharply. Remember, the higher skew goes, the higher chance of a large multi-sigma move to the downside. S&P 500 today now with 57.25% of the index trading over its 20-day moving average. And we see that with breadth coming back into RSP. That had a huge day to the upside, as did IWM, not so much Dow. So, people pricing in rate cuts as being beneficial for small companies. But if those rate cuts don't come, these gains are going to be lost just as quickly as they came. So a little bit of breadth, but the sell-off in tech drastically outweighs whatever improvement we got there. Correlation between the VIX contract in front and VIX still positive, but actually down a little bit from yesterday, and that was probably with the end of the day turnaround in correlation. We're seeing a lot of vol shorting build up at the 55.80 level in order to stabilize prices into tomorrow's PPI print. We might move up overnight. As a matter of fact, I would probably bet that we move to a more neutral position overnight, maybe around SPX like 5600. If we don't, even a slightly bullish print may not be enough to dig us back out of this hole. It'll really depend on how repositioning goes, and hopefully tonight we have some data on that. I don't know what's going to happen. We've been having some issues lately with getting the SIBO data. We're getting everything for like equities, but for some reason SPX, SPXW, and VIX have been giving us weird data and then like no data, or like all the bid ask spreads are all up. So hopefully that rights itself today. And Fed Fund futures now pricing in 0.6 rate cuts going into January of 2025. So pretty big move actually in Fed Fund futures there. That's about 10 bips. So by Jan 2025, they're projecting a effective federal funds rate of 4.9, which is basically like 2.5 rate cuts at 25 points a cut, right? Almost 2.5 rate cuts. I think that's about it. On SPX, this is a pretty clear rejection of the upper trend. Now, this wasn't super important on the daily time frame, but it was pretty important on the weekly out here. We have not fallen back below 54.46, but I do think the 55.70 level that we breached today, which is the prior week's high, is actually pretty important because I believe that's also the prior monthly high, right? 55.23. Yeah, prior week's high. So loss of 55.70, a little bearish. 55.23 more. Loss of 54.46 is a confirmation of a reversal. So we'll see how far this drop extends. What I would say I expect is for this to develop in a way that I would consider bearish. Is I would expect us to trade up over the next like 4 days, 4 trading days, but not form a new high. So stay within this range for the next 4 days, but trade up. And then I think come SLD OPEX, we could see a continuation of the downside. Anyway, thank you guys so much for tuning in. I will see you bright and early tomorrow. I hope everybody has a lovely night. Later, guys.